Hi, and welcome back to this week's Market Carver. I'm Grant Soliven, just filling in the shoes this week for Adam Harder. He's on a much-needed vacation, I believe the anniversary with his beautiful wife. On the show, as always, Andrew Thrasher, our portfolio manager and certified market technician. Andrew, so good to be doing this with you. First time here. I hope I don't mess it up for the team. We've got a lot of good stuff to talk about today, but I'm glad to be here with you.
I'm so glad you were able to fill in for Adam. I think he's going to be pretty jealous when he gets back and sees how much fun we had on the market cover this week. But glad he's able to go take some time away. That's one thing. It's tough for he and I. For a lot of jobs, you can kind of leave, but with the market unfortunately does not close for us to take a break, which is why I don't ever take one. So I'm glad he's able to get away. Hopefully he's enjoying some warm weather wherever he's at, and we'll be back next week with Adam and I. Chopping it up again, but good to have you on this week, Grant.
Oh, I'm loving it, my friend. Hopefully one day you'll get to take a nice break and Adam can have another fill in as well. And so getting into the fun, let's talk about what we're going to discuss today in the Market Carver on this episode, really going through the breakdown of the risk barometer, why we use it, that process. Andrew, going to spend a lot of time with you on the trend and what we're seeing. Go through when do we get signals and triggers to actually get re-engaged in a bullish market, looking at that confidence score, and then talk a little bit about economics at the end here with kind of the inventory buildup and what we're seeing inside the economic portion of the risk barometer. So kind of diving right in. For those of families that have been with us for a long period of time, you know our investment process is called the risk barometer. And what that is essentially is a breakdown of what we see going on in economics, what we see going on in trend. So what's going on from price action, et cetera, from a technical analysis perspective. And we lump that in along with seasonality as our tiebreaker. And that's what Andrew and Adam really spend a lot of their time doing on a daily basis, is evaluating sectors, what's going on outside in that weather. That barometer tells us, when the weather's nice, we can be offensive, neutral, or defensive. And so that's really the process. We try to take emotion out of the game and allow these two gentlemen and the rest of the team to really get into the portfolios for our families. So, Andrew, anything else in the risk barometer I've missed that maybe you want to gently touch on before we start moving into trend?
Yeah, so just kind of broadly looking at the risk barometer, we have three different signals with kind of like a stoplight where you have green, yellow, and red. You can see them on the chart here on the screen. Looking back, this is the S&P 500 with our different signals that were taken. Originally, it used to be a monthly data set. Now you can see that there's a lot more dots on the far right side where it started to become weekly. As we continue to adjust, we're always trying to look for better ways to improve either the way we're managing money, the way we're managing risk. And so we started to actually have that be more of a weekly process. So that's why on the right side of that chart, there's a lot more dots. But traditionally, as the data starts to improve, we go to a green, we go offensive to where we're able to take maybe a little bit more risk in the portfolio, whether that's on the equity side or the bond side. And then if things start to kind of slow down, whether it's the trend that begins to weaken or maybe some of the economic data starts to soften, then we start going to a yellow where we just want to be a little bit more cautious towards the market. Hopefully we'll be able to get back to a more offensive stance with that green. And then sometimes when a lot of the data starts going negative, the economy looks like it's maybe slowing, the trend has started to decline, we go into that red period. The last time we saw that was during the COVID crash back in 2020, when a lot of things started to really slow down and the market had a double-digit decline. The benefit of a risk barometer using this type of data is it takes the emotion out of it. Especially, we saw a great example that was during March of 2020, to where we didn't know where the final low was going to come in early March, but what we could rely on is the non-emotional use of the risk barometer telling us, okay, we want to start becoming a little bit more defensive, take on a little bit less risk, and then wait for the data to improve, wait for it to start telling us, okay, we can start increasing some equity exposure, start getting a little bit more risky. But that's kind of the main use of the risk barometer. It helps us really unemotionally drive the portfolios.
Absolutely. And Andrew, thank you for that deep dive into the risk barometer itself. Let's take a turn now into trend, kind of where you specialize and where your expertise really becomes important for our portfolios. So let's talk about where we're at in trend today. What does that look like? We've seen some volatility. We've had inflation concerns, economic concerns, but trend still seems to be green. Why is that? What are you looking at?
Yeah, so this chart is just, again, the S&P 500 on a weekly basis, going back to kind of early 2008. You can see going forward. And a lot of the most important thing is a lot of that chart is green, because a lot of the time the market is going higher. And so when the market's going higher, we want to be riding that trend. And so when the market starts to get a little bit more whipsawy, when the volatility starts to increase and trend starts to break down, we don't know how long that's going to last for. Back in 07, 08, it was for a long period of time. Since then, we've seen some shorter periods of downtrends within a much longer uptrend. And so during those periods, we start to get a little bit more defensive, again, not knowing where the market's going to take us from there, and just trying to minimize some of that volatility. But this is entirely binary. Is the market going higher or lower? Is it a 0 or a 1? And there's a lot of different data that flows into it, entirely based off the market price action. If we look at the next chart here, we can see one piece of that data. And that is, we not only want to see as the market itself, when we say the market, the S&P 500, is it going higher, but how are the individual stocks doing? Again, at the end of the day, the stock market truly is a market of individual stocks. And when a lot of those stocks are going higher, traditionally, the market itself will also join that trend and go higher as well. So we start to evaluate not just how the broad indices, the Dow or the NASDAQ or the S&P is doing, but again, how are the individual stocks performing? And right now we've seen a little bit of weakness. It got kind of chopped off on the chart, the most recent data here, but we're kind of hanging right around 50%, where about half the stocks are still in long-term uptrends, and about half the stocks have started to become in downtrends. And so that kind of back and forth motion starts to pull the markets up and down. And that's why we've seen a little bit, some of that downside to start out this year, but it still remains that it's still strong enough that we're still in a uptrend as defined by the risk barometer.
Absolutely. And Andrew, another quick question. We get a lot of this coming in from families. So we've had a little bit of volatility, or a lot of it, depending on who you ask, enter the market and the system. And the next chart's can probably throw some people off because it looks a little confusing. But
Yeah.
oftentimes the question we get asked is, when do you know to get back in, right? Or how do we know what to put, where to put money, et cetera? Can you go through what the bullish confidence score is and how you utilize that?
Mhm. Yeah, we'll start with something that's a little bit like Grant said, there's a lot going on here. The next slide, once we get to it, distills it down to one piece of data. But when we have our bullish confidence score, something, again, we want to be non-emotional with our decision making. We want to rely on the data from the market. What's the market telling us to do? Is it telling us to be more defensive, or is it telling us that we can start becoming more offensive? And so one of those models, one of the pieces of data is called the bullish confidence score. And that just tells us that looking at the breadth of the market, the level of participation, or stocks going up or down, similar to like in the risk barometer trend, where we have how many stocks are going higher versus lower. And then looking at the risk appetite of the market. Is there certain parts of the market that's taking on more risk on characteristics? And so there's many different ways for us to kind of slice and dice all the data. And on the next chart, we boil this down to just one single data set. And we want to look at, of those 5 categories, how many of them are saying we should be on offense? How many of these are saying we should be bullish? And when all 5 are, then that's telling us a pretty good sign that the recent dip in the market is maybe a chance to start looking to get back to buying the dip, quote unquote, or increasing some of our equity exposure in the more of a short-term looking period. So the risk barometer is looking much more longer term. We can use some of the shorter term models like this one, the bullish confidence score, to start looking at some of the more of a speedboat to the risk barometer being an oil tanker, where we can be a little bit more agile, a little bit more tactical with our allocations, and looking for maybe it's time where the market's gotten a little bit more confident, a little bit more bullish when these 5 categories start to confirm each other. So as of right now, we're not there yet. We only have 3 of the 5 have been able to rise back to a bullish level. Once we get to all 5, then we can start again looking for reevaluating the amount of risk we're taking in the portfolios, and doing so again from a non-emotional, data-driven perspective.
Absolutely. And Andrew, I love you when you talk about this stuff on the allocation team with the advisors. And I love that you're distilling it down even more for us to simpler terms here on the market Carver. So thank you for doing that. One thing we always talk about that you hear not only from the advisors in our meetings, but also in the market Carver, is you cannot just use one data set to make decisions.
Right.
Right. We always talk about how economy is totally different than the stock market. and they can work in tandem, or they can work separate from each other. And so we don't want individuals making decisions solely off the economy, solely off of their data sets. That's why we have the risk barometer to include everything together to
Mhm.
give us a good idea of what the weather is like outside. So flipping the conversation a little bit, Andrew, going into more of the economic side. Inflation is a big deal. We've got the Fed rising interest rates. What are some other things that we're focusing on from the economic side that are important for our families and how we invest money?
Yeah, so I think one of the headlines that a lot of people are seeing right now is, it's kind of been a theme for the last 2 years, coming out of the COVID disruption, was the supply shock. All the supply issues, whether it's in the auto industry, as they're able to get semiconductors for the computers in the cars to be able to get them on the lots, whether it's food in the grocery stores that maybe aren't as stocked as they once were. There's across all major industries and sectors, we're seeing supply issues. And so one of the results from that is a lot of businesses, because they know it's going to take a lot longer to get the supplies and the inventory they need, they start ordering even more. If they say traditionally we don't only have maybe 50 days to turn around a product, to be able to order it, to be able to have it in our store on our shelves, and now it's taking, from what we're seeing, about 115 days. And so for that, and the different businesses are starting to say, okay, I'm not going to order just the normal amount I would traditionally order for my inventory. I'm going to order twice the amount. And so we're seeing this buildup in inventory. And you can see on this chart here, the U.S. retail inventories minus autos. They take out the automotive industry to because that can be a little bit volatile. And we can see on the far right side, the 3-month change, it's gone up quite a bit. The most recent data is actually the highest 3-month change that we've had in about 20 plus years. So we're really seeing this really strong buildup in inventories. And the where that can kind of start to hopefully doesn't, but what could go wrong there is they build up these inventories with the plan to start selling them, to be able to send them over to consumers, to other businesses, or whatever they use that inventory for. But that's not a guarantee. And so we're starting to see a little bit of retail sales are starting to go down because of that inflation you talked about. And so because some of the retail sales are going down, the consumer may not be as strong to absorb all that inventory. And so that can then negatively impact some of the businesses. And so we're being very careful with not only companies that we own, but also the companies that make up a large part of the stock market, in seeing how sensitive are they to this buildup in inventory, and are they at risk for having a lot of the inventory go stale and unable to be sold down their pipeline to consumers or businesses or whatever business that they're in. So this really buildup in inventory is something that we're going to continue to watch. It's going to be probably a bigger issue in the back half of this year, hopefully with the retail inflation can come down, retail can be able to pick up its strength, and maybe this won't be a problem. But it's something we're definitely keeping an eye on, as some industries could be impacted more heavily than others, and so we want to make sure we're positioned appropriately for that. So just this big buildup in inventories is right playing along with that supply bottleneck issue and the rising inflation. It's all kind of coming together. It's making 2022 going to be a very, very interesting year for many reasons, this being one of them.
Hands down. And it is so wonderful to have you and Adam on the team to be doing and watching this for our families. This is a full-time job, and as many of you are probably starting to see now that Adam and Andrew are doing this together, it is much an art as it is a science. And so the combination of the two and understanding their two faculties and where they bring experience from their designations, but also their training, is important for us. So for those of you that understand our process and understand our team, we're looking forward to our family updates coming up soon if you haven't had yours already. And if this is the first time you're watching this, or maybe you're having a trigger in transition, please schedule a meeting with our team, 800-928-4001. Brittany will be on the other line to schedule that meeting with you, the advisory team. But thank you so much for joining us. And we're looking forward to having Adam back, and Andrew, you going and continuing to do the good work that you guys do on the show here. So if you're looking for more content, please don't hesitate to look up Consider This Program on all of the podcasting services near you, and also the different radio stations that we're on below as well. Again, thank you for being part of the program and watching, and we'll be back with you soon.